Good afternoon. I'd like to call to order the Albany Police and Fire Pension Board for a meeting for October 28th, 2025. Would you please read the land acknowledgement?
The City of Albany recognizes that we occupy the land originally protected by the Confederated Villages of Lejeune. We acknowledge the genocide that took place on the lands, and we must make strides to repay the moral debt that is owed to this indigenous people, specifically the Ohlone tribe. We thank them for their contributions, which have transformed our community and will continue to bring forth growth and unity. The City of Albany commits to sustaining ongoing relationships with the tribe and together build a better future for all that now makes this their home.
Thank you. May we have roll call, please?
Board Alternate Welch.
Here.
Board Alternate Berry.
Here.
Board Member Alternate McQuaid.
Here.
Board Member Alternate Leduc.
Here.
And I am here.
Thank you. That brings us to consent calendar. Consent calendar items are considered routine by the board and will be enacted by one motion. By approval of the consent calendar, the staff recommendations will be adopted unless otherwise modified by the board. There will be no separate discussions on these items unless a member of the board or a member of the audience wishes to remove one of the items from the consent calendar. Does anyone wish to remove an item?
No.
Do we have any public? I'll entertain a motion to approve consent.
I entertain a motion to, I motion to approve the consent calendar.
I second.
May we have roll call, please?
Board Alternate Welch.
Here.
Board Alternate Berry.
Yes.
Board Alternate McQuaid.
Yes.
Board Alternate Leduc. Yes. I vote yes. The motion passes.
Do we have any public comment?
Nope.
No one online? Okay, reports. That brings us to our report on the investment for the quarter ending September 30th, 2025. Could you introduce our guest?
All right, good afternoon, everyone. My name is Rashad McKinney. I'm from CIBC Private Wealth. I know he used to work with Dewey too. He's my colleague, and I'm now assisting him with working on the portfolio account. So as we start off with the review, our review is as at September 30, 2025, the quarter end. I'll start off reviewing the asset allocation of the portfolio, move on to analysis of the change in the market value, that is what constituted the change, to the inflow or outflow of funds, any payment of income, capital gains on the portfolio, and then I'll go into detail discussing the capital gains on the portfolio or the investment performance results for the quarter. Also do a high-level overview of the performance of the account, I guess, for the longevity horizon of the portfolio. So as at last month's end, there was a cash value on the account of about 1% of the portfolio at $14,000. The fixed income allocation of the portfolio stood at $923,000. About half of that is invested in short-term investment-grade funds with Vanguard at $471,000, and a more traditional, I guess you can say, barbell strategy of Dodge and Cox Income Fund at $452,000. The equity portfolio stands at just over $1 million, the Dodge and Cox Stock Fund, and that represents 53% of the portfolio. Total value, just shy of $2 million, $1.996 million. And so we look at what constituted the change over the quarter. So there were net withdrawals out of the account of $300,000, and that represented, from what I believe, any payments out of the account. Income generated both on the fixed income and the stock portion of the portfolio was $16,600. Capital appreciation, $41,000, bringing the total return, combination of income and capital appreciation, at $57,900, and that brings us to what our market value is, as I discussed previously. So since inception, performance over the account. So the portfolio started with us in September 30, 2029 at 10.9 million. Withdrawals out of the account stood at roughly 5.9 million. Income generated on the portfolio, that's coupons and dividends, stood at roughly 2.6 million. The portfolio appreciated in value at 4.2 million, bringing a total return of 6.9 million, and the market value just shy of 2 million, as I mentioned, 1.996 million. So the capital appreciation is really what drives the investment portfolio and how it's going to grow. So year to date, this portfolio has grown 8.14%. That's a gross return. Annualized since inception return is 7.29%. And this, in my estimation, and just based on the performance that we see for most of our portfolios, is relatively good annualized since inception return. There's a law of 7 that says once you can get a return of 7% on your portfolio every year, you're actually in a good place and could potentially double the value of your portfolio over 7 years. So that's just something I think we should highlight. The fixed income allocation of the portfolio, the Dodge and Cox Income Fund year to date, return was roughly 7%. The Vanguard short-term investment grade fund stood at roughly 5.94%. And the equity portion of the fund, the Dodge and Cox Stock Fund, produced a return of 10.9%. Annualized since inception return of this is 12.6%. So the portfolio has been performing relatively well. Fixed income, the income rates in the country and globally, for the most part, have been above board. So these returns on the fixed income side are pretty handsome and just show that the portfolio has been sustaining itself from a balance perspective on the fixed income side and also on the equity side. So are there any questions so far? Okay, so I'll move into our financial markets monitor, and this just gives a high-level overview of the macroeconomic economy and what's been driving the returns in the portfolio. A lot's been happening on the macroeconomic landscape, so I'll try my best just to focus on the points that are pertinent to this portfolio. So if we look back at the past quarter and even at the past year, equities have been performing relatively well, surprisingly well, especially given all that's been going on in the economy. A lot of individuals had fears about tariffs, about earnings, but the equity market has been resilient and provided returns in the U.S. at 14.8%, and this has been a relatively good return. If we look at the developed international market, it's performed exceptionally well. It's been a rebound. It was really suppressed for the past 2 or 3 years or so, but with a lot of incentives that have been placed in the global market, in particular in Europe, Europe has been cutting their interest rates and providing investment in a lot of their arms and just certain government-funded organizations. So they've seen a lot of returns as well. Emerging markets has also performed well at 27.5%. Bond returns were kind of helter-skelter early in the year. With the Liberation Day, the bond market, they pulled back a little bit, but since individuals were able to see some stability in the tariffs not only brought additional revenue to the U.S., they also were able to see that countries negotiated terms that provided stability for the U.S. and also for the global economy as well. So long-term treasuries provided a return of 5.6% year to date, roughly in line with intermediate government and corporate at 5.7%, and then corporate and high yields, of course, providing that additional level of spread above long-term treasuries at 7.1%. And if we look at commodities, the shining star is gold. This year, although the equity market has performed well, there are some individuals that believe that there should be a flight to quality, and they view gold as that representation of quality. So gold, as of September 30th, stands at 44.8%, and since then is appreciated even more. Oil is relatively flat, and the commodity index provided a handsome return at 9.4%. So next slide. And the investment themes that we can look at, and just to keep in mind, of course, and you hear this on the news all the time, is the GDP growth in the U.S. The The markets have been performing well, but there are some tailwinds that we all want to consider. GDP growth is scheduled not to perform as well for the year, running below the long-term average. Monetary policy is also something that's being met with a lot of negativity as well, although the Fed has put things in place to make sure that interest rates are kept at a low level. It's combating that with inflation and also with signs that the job market may be weakening. Business tech spendings and lower interest rates are showing that the equity markets are being supported, but once we remove tech and also the investment in AI, the equity market is pretty flat. So that's something that we want to make sure that we monitor and consider in the event that there is a pullback. We don't want to overexposure in those tech fields. And also, we just consider the uncertainty about U.S. trade. It's been mediated for the most part, but of course we can see there's always communication that things may change. Over the weekend, we saw that China and the U.S. may come to a deal. So that's a positive thing, but if that falls through or if things change within the timeline, that's something to consider as we consider the asset allocation in this portfolio. So the U.S. economy, as I mentioned previously, tech and AI really has been driving the economy, and there's just a question, how long can this be sustained? You might have heard a few discussions, individuals are concerned that we might be in a bubble, reminiscent of what the early 2000s looked like, the dot-com bubble. Sometimes the fundamentals don't really look like that, but there are some arguments that say that we're up on the trend toward that. So that's something that we should consider. Nevertheless, there are a lot of strong indicators within the market. For instance, consumer spending is still downtrending, and there's weaker job growth, but this downtrend in consumer spending is supported to some extent by the use of credit cards. So we're not seeing the full brunt of it. Although there's a weakening in the economy, there's also some of it being sustained by the use of debt. So that's something to be considered, and also that we continue to monitor as we consider the asset allocation of the portfolio as well. And then there is inflation. There was a reading just last week that said that inflation, although of course significantly lower from its highs of 2003 and 2004, it's still not on the downtrend that the Fed considers that it should be at the 2% target. So that's something to consider. That also drives the incentive for the Fed to continue to cut rates. It will provide a need for some boost in the U.S. economy. So these are all things that we look at from the U.S. perspective at the U.S. economy as we manage the portfolio. Next slide. So the One Big Beautiful Bill Act is also another topic that has brought a lot of concern to investors. From the perspective of the individual investor, there are some incentives for middle class and lower class individuals. The tax burden will be lower. Nevertheless, a lot of individuals are looking at the long term because there may be some tax exempt entities that rely on the charitable donations that come from individuals that will receive a tax break, and of course they're not incentivized to make those charitable donations. So there is some fear that's still in the market. Of course, we also look at corporate cash flows once the One Big Beautiful Bill has come into act, and we see in 2026 all the way to 2029 that there is a slowdown in the stimulative to corporate cash flows for GDP. Nevertheless, that's balanced along with the fact that we think that households will have additional income just based on the mere fact that, of course, they're paying less taxes, so they're able to use disposable income to do other things. Next slide. And the consumer really drives GDP. A lot of individuals think about companies and organizations and governments as sustaining the GDP of the United States, but the consumer accounts for 65% of GDP. So how the consumer performs really drives what happens with the economy and the growth of the economy. As I mentioned previously, credit card debt and 90-day delinquencies are at a high. So spending may not have downtrended at the rate that individuals expected, but it's being supported by debt. That's not a good thing. It's always a sign that there is weakening in the economy, and then there's a potential that this may all flip. And then, of course, we're in a place where organizations are looking for bailouts because they're unable to cover the debts that are on their books. So that's something we want to look into and monitor closely as well as we manage the balanced portfolio. The outlook for consumers, it says down here, could be more challenging because we're also seeing a sluggish labor market. We're in the fourth quarter when the labor market should be booming because the holidays is around the corner, but there aren't as many openings as individuals would have expected. So that's also something to consider as we look at the balance of the strength in the economy versus the weaknesses that are there. Next slide, please. And I mentioned this earlier, but of course, the Fed Reserve is looking to bring their rate down to the target. That's been kind of tricky, as we can see at the graph all the way to the end. Normally, that downtrend happens at a quicker rate, but they're balancing the inflation as well as signs of weakening in the employment market. So we'll continue to watch that. And of course, we know that the central bank or the Fed is battling some issues from the White House as well. So this is going to be a difficult argument, but something that we continue to watch and monitor as well, although we see that there are wide disparities in terms of what the target rate should be within the Fed among the participants. Next slide. All right, central bank independence. Again, speaking about the Fed, this second bullet point I thought was pretty interesting because it speaks about low confidence in the Fed's ability to maintain independence as it's battling a lot of headwinds out of the White House and out of Congress. But the Jerome Powell, he's done, I wouldn't say a good job, but definitely has been consistent with maintaining his argument, although we do see that there are dissenting views within the FOMC. There are individuals who think that we're on track for another reduction of 0.25% in the rate. However, there are some that think that the rate should be increased by 1.25. So that says that the committee is not all on the same, they're all in agreement, but nevertheless, I guess they come to an understanding every now and then to continue to decrease the rate based on votes. Next slide. All right, U.S. equities. And this one is pretty interesting, and I kind of mentioned it earlier when I did a review of the investment portfolio and the performance, the Magnificent Seven versus the S&P 500. A lot of managers and also a lot of equity portfolios have found it very difficult to beat the S&P 500. And individuals ask, why? Why is this the case? If the S&P is providing a return of X, managers should be able to at least meet or exceed that. But we can see that there have been a few stocks, they call them the Magnificent Seven, your Apple, Amazon, Alphabet, Microsoft, Meta. They tend to not be able to get all of them in one go. But the 7 mega cap stocks that are really driving the market, having booms in AI, they represent, as it stands now, over 10% of the S&P. So that's a significant risk, believe it or not. It looks like a good thing, but it means that the S&P is really being driven by 10 companies when there are another 490 that really are underperforming. So we can see in the graph that in the first quarter of 2004, the Magnificent Seven really drove quarterly earnings compared to the remaining 490 companies. But if we look at what is projected to happen in the fourth quarter of 2026, they're almost scheduled to be on par. So we're going to see a reversal in that. Of course, that may mean a dip in the market, but what that also means is that there's a level of I would want to say fundamental sense in the market as well. It's not just an excessive overperformance, the small man not seeing the end result of what we see as an excessive overperformance in the equities market, but there'll be a balance. So that's something to look out for, a convergence, as we say, in the rate of earnings growth. So next slide. I think we could skip over this one. And then again, just a lot of different points to be mentioned on international equities, in particular in Europe. Everyone is really spending on defense, and defense represents a great investment for any country. Of course, defense spending is also very expensive, and those organizations that benefit from it are positioned and poised to do well. So that's really what's been driving the overperformance within the international market. So we can see just based on this chart that it has been on the uptrend since 2020, and then after 2025, if we look at the projected rates, global defense spending is scheduled to continue to increase. So that's something that we want to continue to look at. War, believe it or not, is not just a matter of maintaining peace, but it's also a very expensive business, and countries tend to benefit from it. And if individuals invest appropriately, and it's not necessarily the right thing, but if they invest appropriately, they can benefit from it in their portfolio as well. Next slide. We could skip over this. And then looking at the asset class portfolio strategy, this just gives a high-level overview of what the market is poised to do for the next year or so. U.S. equities are still projected to move higher. International developed equities, as I mentioned earlier, projected to do well as there are trade deals in the U.S. and also stimulus coming out of Europe to ensure that there's support for spending in defense. Emerging market, it has performed well, but they say there are headwinds with trade and policy. There's a lot happening in China and in India and the smaller countries that are on that side of the world. I think they're forming negotiations, trying to put pacts in place, so there may be a bit of a delay. So that's something to continue to look out for on that side of the world in terms of equities. Fixed income cash, there is a projection that the Fed will continue to cut rates. As rates decrease, market value increases. So we'll see some positivity coming out the fixed income segment. And then in terms of real assets, energy is showing signs of recovery. And although clean energy was scheduled based on the election not to perform well, it actually has performed well for the year, so that's something to continue to look out for. Real estate, the signs are essentially the same. This report will consistently show that there are elevated vacancy rates, and there's not really been any sort of innovation to show how we can resolve that from a corporate perspective. So real estate represents a difficult space to invest in, but if we look at infrastructure, the changes that are happening within municipalities and in countries, there's opportunity in that perspective. And then alternatives, of course, alternatives is not really a good candidate for this particular account, but credit and private credit, as mentioned previously, there's an opportunity and growth there. And private equity and deal making has picked up as we see a slowdown in small cap companies really moving from being private companies to public companies. And that's my overview. If there are any questions, I'll be happy to take those.
I have one question.
Sure.
If the government shutdown continues past November 1st, past January 1st, what happens to all this information? What's the overall effect?
So what we believe will happen is that this will show the shutdown will continue to affect the individuals that are part of the U.S. government. They will not see the income. And as a result, like I mentioned earlier, 65% of GDP is caught up by consumers. The U.S. government represents a very large employer. So I don't think it would result in something as catastrophic as a recession, but we would see a slowdown, and that will trickle up to organizations and like stores. If folks don't have jobs, they won't buy stuff for Christmas. They won't have very large dinners for Thanksgiving. And so these organizations will see the hit of it. So I do think we would see a hit. Maybe the equity market won't perform as well for the new year. But it is projected that, and history shows that, well, it's hard to really use this as an example and compare it to history because this shutdown has gone on longer than anything we've seen in a very long time. But shutdowns tend not to have a significant effect on the market for the long term, but definitely on the short term. So this fourth quarter, I think, if things don't change, we won't have the performance in terms of earnings for the corporates that we would have projected.
Is the same true of the projected rise in healthcare costs? If people are spending more on healthcare, they're not buying commodities?
That's true as well. However, we do see within healthcare there are a lot of innovations that are happening. Believe it or not, there's a perception that, of course, healthcare, they're all money hungry, but there are innovations that are currently in work and in play to make sure that there are efficiencies and individuals can get access to medicine at a different rate than they used to in the past. So I think this could also drive innovation within that market, because there is a call and a drive for cheaper, efficient means for individuals to access healthcare if we look at medication. But yes, healthcare would be affected. And I think we saw something similar within the pandemic. Folks didn't have jobs. They weren't as prone to go into the healthcare facilities and get the care that they needed, and that resulted in a downtrend in healthcare in that segment. But again, in terms of the economy providing efficiencies to work itself out, that's what happened during that period, and I anticipate that this would happen again during this time period.
Thank you. Questions? Any online? Okay, so we just note and file, is that correct? Thank you very much for coming and doing your presentation.
Thank you for your time.
Okay, that moves us to item 5-1. We have a staff report. We need to approve, we've all looked at the material, is that correct?
Yeah, it's
Just the regular, okay. Do you need a motion to approve?
correct.
Yes? Oh,
I motion to approve the staff report.
Thank you.
second.
May we have a roll call, please?
Okay. We're moving to approve the annual payment update.
Correct.
Alternate Welch,
Yes.
alternate Berry,
Yes.
alternate McQuaid,
Yes.
alternate Leduc,
Yes.
and I vote yes, so the motion passes.
Okay, that takes us to announcements. Do we have any announcements or requests for future agenda items? Seeing none, I think we are adjourned.